Welcome to Money and Markets, Series 1, Lesson 7. This episode is called Lockup, Maturity, and Term Premium. In Lesson 6, you learned that the bank pays you less than it charges borrowers. The spread exists because of costs, defaults, and risk. But there is one more piece we flagged without fully explaining: the maturity mismatch. Banks take in short-term money and lend it out long-term. That timing gap is a risk. And when you agree to lock your money away for a longer period, you expect to be paid more for that patience. This lesson is about why. Why does a 5-year deposit pay more than a 3-month deposit? Why does a 30-year mortgage cost more than a 5-year loan? The answer has two parts. One is about human preference. The other is about uncertainty. Together, they create what markets call the term premium. First, the definition. Term to maturity is the agreed period from the day you commit your money to the day you get it back. If you buy a 3-month certificate of deposit, the term to maturity is 3 months. You hand the bank your money today, and in 3 months you get the principal plus interest. If you buy a 5-year CD, the term is 5 years. Same idea, longer wait. The key trade-off is simple. While your money is locked, you cannot use it. You cannot spend it. You cannot move it to a better opportunity. That lockup has a cost. And the longer the lock, the higher the cost. A savings account, by contrast, has no fixed maturity. You can withdraw anytime, but that flexibility comes at a price. The bank pays you almost nothing for it. Savings accounts offer very low rates precisely because you can take your money out at any moment. The bank cannot count on having those funds tomorrow. Here is why longer maturity usually means a higher rate. 2 reasons. Reason 1. Time preference. People prefer to spend now rather than later. Coffee today, a vacation today, a new phone today. This is the same preference you met in Lesson 1 when we asked whether you would take $1,000 today or in 1 year. If you want someone to wait, you have to pay them for waiting. The longer they wait, the more you pay. That is the time preference component of the rate. Reason 2. Uncertainty. The longer you commit money, the more things can go wrong. Inflation might spike. The economy might turn. Interest rates might move against you. The borrower might default. Over 3 months, these risks are manageable. Over 30 years, they are large. Lenders demand extra compensation for bearing that additional uncertainty. And that extra compensation is what pushes long-term rates above short-term rates. Together, time preference and uncertainty create the upward slope of a normal yield curve. You saw that shape in Lesson 2. Now you know the economics behind it. Let us put numbers on the ladder. Imagine 4 products at the same bank, all on the same day. A savings account with no lockup. Rate 0.5%. A 3-month CD. Rate 3%. A 1-year CD. Rate 4.5%. A 5-year CD. Rate 5.8%. Watch the bars on screen. Each step up the maturity ladder pays a higher rate. Not because the bank is being generous, but because you are giving up more flexibility each time. And the longer you lend, the more uncertainty you face about what rates and conditions will look like when the lockup ends. At 0.5%, you keep full access. At 5.8, you are locked for 5 years. The rate compensates you for patience, lost flexibility, and the added uncertainty of a longer horizon. Now here is the practical question. Should you always go for the longest term to get the highest rate? No, because you might need the money. Early withdrawal penalties on CDs can eat into your returns or even your principal. The right maturity depends on when you actually need the cash. The same logic applies to lending, not just saving. When a bank makes a 1-month loan, the uncertainty is low. The economy probably will not collapse in 30 days. the borrower probably will not disappear. When a bank makes a 30-year mortgage, the uncertainty is vast. 30 years of potential job loss, illness, economic downturn, policy changes, and inflation surprises. More time means more chances for something to go wrong. So the bank charges a higher rate for the longer loan. Not because it dislikes the borrower, but because the probability that something disrupts repayment increases with every additional year. This is the same upward slope again. Short loans are cheaper. Long loans are more expensive. The difference is the term premium, the extra compensation the lender demands for bearing the risk of time. You can now see why the maturity mismatch from Lesson 6 is dangerous. The bank borrows short at low rates and lends long at high rates. That spread is the profit. But if short rates spike suddenly, the bank's cheap funding becomes expensive, while the long loans are still locked at the old rate. Let us connect this back to the yield curve you met in Lesson 2. A normal yield curve slopes upward. Short maturities on the left, low rates. Long maturities on the right, higher rates. Now you know why. Time preference says people want compensation for waiting. Uncertainty says longer horizons carry more risk. Both push long rates above short rates. But remember, Lesson 2 also showed you an inverted curve. Short rates higher than long rates. How does that fit? If longer always means riskier, why would anyone accept a lower rate for 30 years than for 3 months? The answer is expectations. When markets expect the central bank to cut rates in the future, long-term investors are willing to lock in a rate that is lower than today's short rate because they believe short rates are heading down. An inverted curve does not mean uncertainty disappeared. It means the market's bet about the direction of future rates is strong enough to override the normal term premium. That is a subtle point. Sit with it for a moment. The term premium is not something you can observe directly. You cannot look it up on a screen. What you can observe is the yield curve, the set of rates at different maturities. And you can decompose that curve, at least conceptually, into two pieces. First, the expected path of future short rates. This is what the market thinks the central bank will do over time. If the market expects cuts, this component pulls long rates down. Second, the term premium. This is the extra compensation investors demand for bearing maturity risk. This component pushes long rates up. The actual long rate you see in the market is the sum of both. When the expected path component is falling fast, and the term premium is not large enough to offset it, the curve inverts. When expectations are stable and the term premium dominates, the curve slopes upward normally. This decomposition is not something you need to calculate today. But knowing it exists gives you vocabulary to understand what bond traders and central bankers are arguing about when they discuss the curve. Practical decisions. When should you lock your money for longer? Only when you are genuinely confident you will not need it before the term ends. CD penalties for early withdrawal are real. Some banks charge you months of interest. Others may dip into principal. Before choosing a maturity, ask 3 questions. First, when do I need this money? If the answer is maybe in 6 months, a 5-year CD is the wrong choice, no matter how attractive the rate looks. Second, what is the penalty? Read the fine print. Some flex CDs reduce the penalty. Some eliminate it. But nothing is free. You learned that in Lesson 5. Third, what are rates likely to do? If you expect rates to rise sharply, locking now means missing the climb. If you expect rates to fall, locking now captures a rate that may not be available later. These 3 questions are the same structure from Lesson 5, applied to the maturity dimension. How much, how long, and what is your rate view? Every deposit decision circles back to those 3. One more dimension. Default probability also increases with maturity. This is not just about time preference and uncertainty in general. It is specifically about the risk that a borrower will not repay. Over a 1-month loan, the chance of default is small. The borrower's income, job, and health are unlikely to change dramatically in 30 days. Over a 30-year mortgage, all of those things can change multiple times. Recessions happen. Industries shrink. Health emergencies hit. Marriages end. Every additional year on the calendar is another year where something can interrupt the borrower's ability to pay. So when you see a higher rate on a longer loan, part of it is the term premium for uncertainty. And part of it is the lender pricing in a higher cumulative probability of default. This connects directly to the next lesson, where we focus entirely on default. What happens when borrowers break their promise? 3 takeaways to carry forward from this lesson. 1. Term to maturity is the length of the lockup. Longer maturity means higher rates, because you are compensated for giving up flexibility and bearing more risk. A savings account with no lockup pays almost nothing. A 5-year CD pays substantially more. 2. The upward slope of a normal yield curve comes from 2 forces: time preference and uncertainty. People want to spend now, and longer horizons carry more risk. Both push long rates above short rates. 3. The term premium is invisible but real. You cannot read it on a screen, but it drives the difference between short and long rates. When rate expectations dominate the premium, the curve can invert. Next lesson, we talk about what happens when the borrower stops paying. Default, grace periods, covenants, and the Italian origin of the word bankruptcy. I will see you in Lesson 8.